Okay, good afternoon, guys. If we're all ready, I think we can get started. Okay, what we're going to talk about today is all about money management and trading volatile markets. As we all know, the markets are very susceptible to fundamental shifts and, again, are trading technically, but again, with the kind of real extremes in price movement and, the relatively thin liquidity at the minute, the markets can move, in great directions. So what we're going to talk about today is how we can control our money management, our level of risk, how we can look at the volatile markets, and the different techniques we can use to make sure that we trade the markets responsibly and in a way that we can preserve our capital. So before I start, I always need to read the risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital, with the possibility of losing more than your initial investment. These products may be suitable for all investors and only intended for people over the age of 18. Please ensure you're fully aware of the risks involved and necessary to seek independent financial advice. And again, this is educational only. The content of this webinar is personal opinion of the moderator, not intertrade.com. Content does not constitute financial, investment, or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. And intertrade.com is not responsible and disclaims all liability for the content or comments during this session. Okay, guys, so the key to successful trading. Okay, the biggest reason people do not make money in trading is quite simple. They let the losses run larger than the profits. Now, as most things, that sounds obvious, but most traders, in my experience, and that's not just from being a trader myself, but from also being a risk manager for some of the biggest traders in the city, people get married to trades, and it's something you hear and you do witness very often, that people tend to form an opinion, to form a trade, and they can't, for whatever reason, get out of the trade because they don't want to realise that loss, they don't want to admit they were wrong, they think that the market's being manipulated, being pushed. And all these things, again, it goes back to a lot of the webinars that I host on trading psychology. It's to not take the markets personally, to not get involved in a trade and think that's the only trade you can do. I think the biggest thing to remember when you're trading in volatile markets is there's always going to be more than one opportunity to get into a trade. So when the markets are moving, in big ranges, you can get these individual candle moves, in 5, 10, 15 minute charts. They can move anywhere between 60 and 100 pips. So that's a lot of room to play with. So what we have to understand is that if we don't catch the initial move, it's certainly not the end of the opportunity to make money. And when the markets are extending and are moving quite aggressively in one direction, there will be more than one opportunity to get involved and to trade the overall move. So again, all we're going to talk about today is how we can manage our risk, how we can control our exposure to the market, then the kind of things we can put in and we can implement to allow, that safety element. And it's all things like putting stops in place, putting trailing stops in place, anything that's going to be physical in the market, that if you do get the wrong opinion or the markets do move aggressively against you, you've got that safety net. Because again, it's all about controlling your capital. And it's very, very important because, again, when the markets are moving around like this, if you are on the back of, perhaps a wrong trade, or you've not been paying attention to the fundamentals, and again, you're trying to hold on to a trade when the news in the market is fundamentally driving it in the opposite direction. So again, I've been mentoring a lot of technical traders recently, and again, they find it very easy to interpret where the market's going to go, and the overall highs, the overall lows. But what they're not able to cope with is the volatility once you get into that trade. So again, that's really where we have to look and identify what's the right way to get into, your entry point. What's the right way to enter the market? And there's lots of simple techniques that we're going to talk about this afternoon, and they range from, again, using different, perhaps oscillators to find the right point, or even trading smaller size and positively or negatively averaging in to a position rather than just putting all your original investment or size on in trying to catch the move before it happens. Okay? So again, it's all about being a disciplined trader. You don't want to be the rogue trader. Okay? Every time you hear of a rogue trader, it's because they've lost a lot of money. Okay? So recently with UBS and obviously Nick Leeson famously, but again, you never hear about the guys that just took a punt and made loads of money, because it very rarely happens. And that's, again, that speaks from personal experience. So a simple statement. Again, if you don't look to make more money on profitable trades than you do losing trades, in the long run, you're doomed to failure. So again, the reasons why people hold on to unsuccessful trades and don't manage the risk properly is because of, one, it's fear. It's that actual fear of realizing these losses, seeing that red P&L, the big minus, and pressing the button knowing you have to swallow that loss. The sooner, again, we realize that is a part of trading, and at some time or another we are going to take an unsuccessful trade, a losing streak, the better traders we're going to become. And also, not taking it personally and not letting it get out of control. If you ever press that button and say that, right, that was a really big hit, I really didn't want to lose that amount of money, and you have that gut feeling, and you have the wherewithal to say that was a really, really terrible day. Well, that's because you've not been keeping to your rules. You should know before you get into any trade that if you get stopped out in that particular trade, you have enough capital to carry on trading with a reasonable size, and you know that you live to fight another day. If you're ever pressing that button to get out of a trade and you say them things that I've just said, that, wow, that was a really big loss, I couldn't afford that, etc., etc., then these are the things, that are really going to affect your trading. And these are not good elements of risk reward and controlling how you enter the markets. So again, that ties in with the poor rules. You've either not put a sensible stop in place, or you haven't said, if my trade goes X ticks or X amount against me, then I'm out of the trade. You haven't stuck to them rules. So again, it's all about your trading plan. It's all about having these things in place, physically written down in front of you before you trade. And again, very, very important at the minute, you have to be aware of fundamental news. Again, time after time, technical traders will tell me that you do not need to know about fundamental news. You can fade it out, and again, it will always retrace or come back. That is rubbish, right? Simple. I've traded the markets too long. I've seen too many things, and if you discount fundamental news, you do it at your peril. So I'd suggest that you're more of a 80-20 type of trader. 80% technical, but 20% keeping an eye on them fundamentals. Understand, the sentiment of the market. Understand that when people like Mario Draghi or Ben Bernanke speak, what that means to your market and what they're saying. Okay? Very, very important that we understand what is going to be happening with the market. And again, fundamental figures. These are really, really important. If you want to watch me trade live figures, again, I'll send you an email of how to contact me, etc., etc. I do this, and I tell you how to interpret fundamental news. And then again, we understand really what the market's thinking. We understand how the market can react, and then we switch to our technicals. We know our levels of support. We know our levels of resistance. And these are the things, these are the things we can do. We can trade off the back of information, but then turn it into a technical perspective, and then, use our candlestick formations, again, use our daily levels, our weekly levels to see where the market can push to. And that's all we're doing. And again, by understanding first and foremost what the fundamental news means to your market, then once the market is interpreting that information, then all you're doing is looking technically where it can be pushed to. And again, a lot of traders and a lot of people that are starting out try to make these things overcomplicated, and they're really not. Again, trading on charts should be second nature to you. You know that your entry point is critical, but once you're in the trade and it's going well, all you're looking for is points of attraction to be hit and broken through, or turn and reverse. And that's where you exit and take your profit. Okay? So I can see that people are asking some quick questions. So, does it make your equity curve much smoother by cutting down on before the stop, smooth like a moving average? Right, okay, well, when you average into a position, all it means is that you're trading maybe a half or a quarter of your normal size. So that just means that if a market moves, 10, 15 ticks from your entry point, for or against, and doesn't seem to have a proper direction, just means you can weather that pain. You're not getting stopped out for a finite amount of ticks on the downside. So again, once the trade starts to go onside or starts to go in the direction you think and gains momentum, then you start buying into the trade, putting more size on if you're buying the market, or selling into the fear, okay, and the market being driven down to give yourself more momentum. And that's just another form of trading. If you trade smaller size, again, just think about it in money terms. If you generally trade, let's say for argument's sake, £10 a point, every time that moves, you know exactly what you're going to lose. So if you're £100 offside, i.e. 10 ticks, then you know that's, maybe your finite stop. If you then just trade £3 a tick, if you're 10 ticks offside, that's only £30. So that's not really that frightening. And then it'll go back maybe 5 ticks, then go back another 10 ticks. But again, you're still, not in that finite amount of money that you're willing to lose for that trade or that day. So again, once it starts to come back, you're only £15 offside, £10 offside. Okay, it's a good point to buy some more. And then as it starts to go onside and in profit, you add into the momentum and add into the size of the trade. That's just a very simple technique. Okay? And other things that people don't get out of trades for is because they just have the wrong opinion. Okay? Knowing when you're wrong as a trader, in my opinion, again, is much more important than knowing when you're right. When you're right, trading seems to be quite easy in all fairness, and we can justify any reason why we got into the trade when you're on side and you know where it's going to go, and it feels good. When it feels bad and you don't understand the markets and you're saying all these things to yourself that A, I don't understand why the market's doing this, B, I have no technical levels why it's doing this, I have no fundamental understanding why it's doing this. That's when you need to have the strength of character just to stop yourself out of the trade and go, okay, well, I'm not going to interact with the market until I understand what is going on. Okay? So what is risk management? Well, it's the same as cash management. They're just one of the same thing. We need to protect that capital. So the biggest mistakes people make when trading the market is not understanding or managing the money. Again, it might seem, if you've traded for a while, that that's second nature. But it's not. People just see money. Again, when it's in your trading account, it's almost like when you go back to betting online. It doesn't seem like real money. If you're in front of if you were trading the markets and every time you went on side, somebody was sat next to you and gave you a crisp £10, £20 note, that becomes real, it's physical. But when things are moving around and they're just numbers on a screen, it's very easy to get, disengaged with, what reality is. So again, it's all about putting these rules in place and understanding, what these moves mean and what it means to your capital. So remember, capital is king in trading. It's the most important resource you're going to have. Because capital by its very definition is not the most important asset because it gives you confidence, but it facilitates how much and how frequently you can trade. So again, remember the difference between, obviously, betting on fixed odds and spread betting is you can lose more than your initial investment. It's not a set amount of money that I put £10 on that the markets will go up, I make X amount of money. Every time the market moves against you, that's taking away 1 times your stake. Okay? Okay, Buki, well, you know why you can lose more than the initial stake, because I've just explained, the market goes against you, then every time the market goes against a pip, against you, an increment, a movement, whatever you want to call it, that takes away that times your stake. So if you got 10 ticks offside on £10, you lose £100. You only staked £10 originally. So it's pretty self-explanatory there. Okay, and there's certain things that I always tell any trader that I've ever worked with. Okay, and it doesn't matter if you're in the market for a day, a week, a month, 10 years. Act like a pro, even if you're a novice. Okay, you need to think and you need to act in this way. If you want to be a successful trader, a lot of it's mindset. Okay, no one can see you trade. There aren't cameras watching you, despite what you may think when the market's going against you. And the market truly doesn't care about you. I guarantee it. Okay, so don't ever take anything personally. There's 4 basic rules that I always tell people to follow. We're going to come to them in a minute. But the main one, again, and the main kind of emphasis I try to empower people with, avoid excuses. Okay? Nobody cares. How many times have you spoke to a friend, your partner, a significant other when you've lost money? They almost look at you like you're mad if you've lost money in the markets. It's like, well, that was really stupid, and why'd you trade, and etc., etc. People don't get it, and they don't care about your feelings. They don't care about the market being pushed, moved. They don't care about highs and lows. They don't care. Okay, so excuses are futile. Trust me. And again, remember, the market isn't against you. Yeah, the market is just facilitating price action. Right? So it's not against you. It's not in favour of the banks. It's not in favour of the big traders. It's just doing what the market does. It's fulfilling its function. And accept that you're not going to get the market right all the time. Yeah? It's just a simple fact. From myself to, who knows, Warren Buffett, it doesn't really matter. At some point, we're going to have a bad run. We're going to have a bad trade. We're going to have to accept a loss. That's just trading. Okay? And it's how you deal with that loss is going to define you as a trader. Because again, we can all take profits, say we're right, pat ourselves on the back, and go, well done, that was a good trade. Very, very few people could say, okay, I accept that loss, but I stayed within my risk reward. I didn't risk too much. I stopped out when I thought I was wrong. It was the right thing to do. I lived to fight another day. let's find the next profitable trade. Yeah? And if you can approach the markets like that and approach your losing trades like that, then you're going to be a very, very powerful trader. Okay? So the 4 basic rules that I talked about, pretty common theme in anything that I present and anything that I write about. Number 1 is preparation. Okay? Informed is forewarned. Simple as. If you think you can just turn on your screens and trade, yeah, you might have a lucky streak, you might win a couple of trades. In the long run, which trading is a marathon, not a sprint, you're going to get caught out and you're going to lose money. Okay? Only because I've seen it literally 1,000 times. Okay? Literally. Number 2 is your entry level. Yeah? Don't ever rush into trades. Very, very easy when you see the markets moving around, especially when there's volatility. You think you're losing out. But again, the old rules are always the most important ones. If you think you've spotted a trend, you've already missed it. Okay? And the volatility is just, again, a way of getting into trades and facilitating movement. So again, there's different things I'm going to talk about a little bit later on of how we can get involved in volatile markets without just jumping onto the trade and expecting it to go instantly on side. So then again, number 3, we've got our target level. So we have to understand where the market's going. And that comes back to our technicals. So fundamentally, when markets drive fundamental news drives the market, we should know technically where it can go to. Again, if yesterday's highs and lows was 200 pips apart, then you have to know how far the markets are likely to move. Sometimes the markets might move 2, 3, 4% in a day. So why are you trying to scalp and make 1 or 2 ticks? Trade the market for what it's telling you. Okay, if the markets are volatile and moving 30, 40 ticks in a straight line, then that's what you need to go. You need to try and get as much of them overextensions as you can. Yeah, and when the market turns and reverses, get out or go with it. So again, number 4 is your stop level. Where am I wrong on this trade? And as I always say, you need to know you're out before you get into the trade. It's just as important to have a level of downside risk and to have a stop, a trailing stop, a finite stop, amount of ticks, amount of money, whatever works for you. Again, it's not, again, a lot of the times I don't trade with stops. Okay? Not to say that's right for everybody, but again, I've been trading for years. So I've got a big account, I can trade, I can average, and, if I'm wrong, yeah, I can take that on the chin. That is fine. But there are different techniques we can all use in different market conditions. And again, when you're trading volatile markets, it's always a good idea to have some sort of safety net, because just as quickly as you can go inside and make money, we all know that when we're wrong, we can seem to lose it 2 or 3 times faster than you do when you're actually making money. And that's just a part of trading, part of life. And again, it's something we can't control apart from where we get out. We can't control how fast or how quick the markets move. So again, it's all about empowering ourselves. So preparation, as I said, please don't just log on and trade. Even if you just do 5 minutes of preparation, it will make the difference. Okay? So look at what the currency pairs have done overnight. What's relevant to the markets you trade? See if there's any overnight news. Okay? Did it move the markets if there was news, as you expected? What data is coming out today? Always very important to check the economic calendar. There's no excuse these days to not. You can get it on Bloomberg. You can pull it off any trading platform. Will have an economic chart calendar of what's coming out. So know about your non-farm payrolls, know about your sentiment figures, and again, know about the markets. Okay? As I keep saying, I do live trading sessions so you can watch me, but we don't trade CPI figures or PPI. So it's not like 5, 6 years ago, when we had a stable economy and all we ever listened for was Jean-Claude Trichet to talk about price stability. So we wanted to know what inflation was doing. So the economy was growing, everything was fine. So we just didn't want inflation to creep up. So we're looking for price stability. So we look at our consumer and producer price indexes to see what that is. But that was back then. We don't care about inflation really these days. We're looking for growth. So it's all about non-farm payrolls, the additions of creation of jobs. It's all about the sentiment figures, like our Michigan and our Philly Fed. It's all about GDPs. Where's the growth coming from? So that should come into your preparation. Look what the market's trying to tell us. So then again, what do you expect for the day? Try and give yourself some daily bias. If the market's sold off for the last week, then what's the likelihood is that it's going to carry on to sell off? Or will there be a correction? And again, if you're trading technically, what are your levels? What are your targets? You should always know in every market you trade what's a key level. What's a key level of support on the high side? Low side, sorry. Where's a key level of resistance on the high side? That's what you need to look. Then we've got the weekend analysis. Again, something people don't tie into the risk management, the money management, the preparation, the planning. We can talk about that now. Benefit of weekend analysis is generally, if we're intraday traders, we don't keep positions overnight or over weekends. So what you're going to have is 2 days when the markets are closed to almost rethink about everything you've done, review the trades, and again, you have to review your risk management strategy. Okay, did you stick to your rules? Okay, are you profitable because you've stuck to the rules, or have you lost money? Where can you improve in these rules? Where do they need to be tightened up? Do you need to trade smaller size? Do you need to trade less frequently? Or are you just losing in one market? You know, if you're trading the euro dollar and consistently losing, stop trading it. There are a million products we can trade, and as long as we can chart and we can understand fundamental information, it doesn't matter what the product is. Okay, another important thing, it always made me laugh when I was in the city and people would say, yeah, well, I'm a FTSE swing trader. You know, what does that mean? What does a FTSE swing trader really mean? It just means you trade the FTSE and you try to get them on the back of momentum. You know, a scalper is a scalper because he looks to be in and out quickly. You can't do that these days on spread betting platforms. It's just too difficult. So you need to find the back of these good moves, and there is volatility at the minute. There's at least 2 or 3 opportunities every day to trade and make money. And that's what you need to be looking out for. And that's the whole point of doing all the preparation, the analysis, to be able to benefit from these extensions and this market movement. That's all we're doing. So again, be firm on your opinions and your views, but be flexible as well in the same time. You know, again, as I keep saying, you know, you can say you're a swing trader, say you're a scalper, but trade the market conditions. If your particular style, your risk management, your entry techniques are not working, then perhaps you're trading them in the wrong kind of conditions or the wrong products. So stop. Change something. You know, again, Einstein's theory of madness. You know, if you keep doing the same thing over and over again, expecting different results, what's really going to happen? You know, so you have to change something. You know, change something in yourself, the things you can control to change the product you trade, your entry point, trade smaller size. All these things are in your control, okay? So your entry level. So depending on your trading style, working out your entry level can enable you to preempt market moves. So again, this may be dynamic or predictable, but knowing what to do when a market reaches a certain point can give you the edge, okay? So it's not what to do now, it's like when you know we're reaching the extremes of the markets. Again, as I keep saying, when we're trading volatile markets, if the markets broke through a key level of support and resistance, you know, and it was aggressive and it closes below or above that line, then that's confirmation that the markets are breaking out and are moving aggressively and quickly in one direction. So you need to stay with that momentum, yeah, and use the open and closes of the next candle or bar, however you trade, as confirmation. So yeah, again, that's why it's so important to have these key levels in place. And these could be your pivot points, they can be previous highs or lows, they can just be anything you think other people in the market are looking for as points of attraction. And again, it's not about having these perfect levels that, you know, nobody else knows about apart from you. You want everybody to be looking at the same things. You want to go in with the market sentiment, go in with what other people are doing. Yeah, very, very important. So again, think about what the market might do in response to certain figures. You know, do you need to go with the price action, or are you going to wait for the market to retrace? Okay, these are things. And again, remember, when we have these big moves and these big spikes of volatility, that 80% of the time, okay, the market will retrace 50% of the initial move. So you don't have to chase it. This is a technique I use all the time when I'm trading the markets, especially when I'm trading things like non-farm payrolls. I'll let the first 3 or 5 minute candle print, and then the next candle, depending where it opens, yeah, I will let that retrace the previous candle or go with the momentum carrying in one direction to make my entry point. Okay, so again, it's just other techniques we can use to trade initial volatility. Okay, just getting a few questions coming through. Right, is this for each pair? If you don't leave your trade overnight for the weekend, what time do you place the last trade then? Or does that mean you don't place a trade after a certain time during the day? Well, you know yourself, Bookieman, you've just traded the markets before the markets close. That's an intraday trade. If you don't close it, then the markets do close and you hold that position until the market opens the next day. So don't trade before the market closes. Simple. But again, currency is a little bit different. You know, you can trade them pretty much 24/7. But again, you know, we can trade a million different products. You know, currencies are just one thing. You know, we talk about the indices, gold, silver, commodities, anything. Okay, GY saying, never used pivot point before. Do all trading platforms have this analysis? Well, pivot points are basically just a mathematical formula. If you just Google pivot calculator, and you can put the previous high and low for the day, and that will just tell you the likely midpoint of the next day's trading, the resistance point R1, 2, and 3, the support points S1, 2, and 3. So it could just tell you where the market could extend to. That's all simply a pivot point is. It's like a form of Fibonacci, to be honest. Okay, number 3, target levels. So what are you aiming to achieve out of the trade? Okay, that's again when we go back to looking at what's happened yesterday or the day before. If we're looking at volatile markets and the markets are moving 2, 3, 4%, then we shouldn't be looking for small moves. Again, we're looking for the big continuations or the big retracements, because the bigger the market move, the bigger and quicker it'll snap back. This just happens all the time. Okay, so remember, is the market primed for a big move, or is this just a sucker move? When you see the big candles print, okay, and they have a big body, that's consistent selling or buying at each price. When you see a little tiny body and a big wick on the candles, either side of it, that just shows that the market's quickly blipped to, highs and lows and then come back to value. That's a sucker move. That's not a sustained move. So other things we need to look at in our candlestick formations, the big fat bodies, very important, green and red ones, to give us bias. Okay, don't be greedy. If you've caught the back of a big move, yeah, then take profit out. Never leave money back on the table, because these markets can snap back to value and snap back against you very, very quickly. So again, it's that fine line between being ambitious, being aggressive, or being controlled without being arrogant. Yeah, if the market goes 50, 60 ticks on side, then you need to be taking 40 ticks out of that. And again, we can use trailing stops, which we'll come to into a minute, in order to control that risk. So okay, once you've set a target for where you believe the market's going, stick to it. Okay, at least take some profit out and let the rest run, or take all your profit out and look for a continuation and a new trade. Don't just let these levels be hit and do nothing about it. Okay, the market will often, when it's trading volatile and when it's trading aggressively, push further than you initially thought through these big levels. Okay, so again, you might get out of where the target level is, and then the market continues another 20, 30 ticks. But I mean, that's fine. That's life. You can't always make the most out of every single trade. But what you can do is bank some profit. If you think the move's going to continue, trade again. But treat it as a new trade with the same rules as you did the initial trade. Don't just, again, get excited and go, wait, it's going to the moon, it's going to keep going up, and then just keep buying it without a real plan in place. And again, I'll come to the classic excuse for not taking profit, not stopping out, I wish I'd done that, I wish I'd stopped at that point. We all say this, it doesn't matter if you're a professional trader, beginner trader, we all know when it's right to stop in our heart of hearts, and sometimes we just get complacent or greedy and we regret it. But again, as long as we can identify that in our trading and we can learn from it, we're going to become better traders. It's only the traders who keep doing things wrong or consistently getting on side and not taking profit and scratching or taking a loss. And they're the traders that don't get involved in the markets anymore. Okay? So your stop level. So this is a big one. And again, in reality, maybe it should be one of the first of our 4 rules. But again, we have to know where our out is before we get into the trade. What if we're wrong? Where do we get out? How do we protect that capital? Yeah? And that can be a finite stop. It can be a percentage of your capital as a whole. It can be a set amount of money you can only use or lose each day. But again, it's down to you. It's down to you, your level of risk, your level of aggression, and what you're looking to make. You've got to spend money to make money. So it's all about how much money you want to spend versus what you think you're going to get at the end of the day. So again, once you've decided that the price at which you're wrong, you've got to stick to it. Don't change it. Don't say, well, I'll just give it another 5 ticks, another 10 ticks. I'll just wait for the next candle to close, next time print to happen. Get out. Okay? Just get out. If that's your rule, get out, stay out. Yeah? Form a new opinion, form a new plan, and then re-engage with the markets. Give yourself at least 5 minutes. The world's not going to end or change in 5 minutes. There will be more opportunities. Okay? So don't just jump straight back in. Perhaps walk away from the screen. Anything. Just give yourself a fighting chance. Okay, so stop yourself out before the trade is not a happy event, but you have to do it. Again, the way I justify being stopped out is that I paid for that information. I knew how much it was going to cost me to put that trade on, and I knew it was going to cost me if I was wrong. Doesn't mean I'm wrong overall. The market can still do what it needs to do. But if you say to yourself, well, I've justified that stop loss, I've paid my 20, 30, 40, 50 pounds or whatever to realise that that was the wrong entry point for this particular time in the market. and that's how I justify being stopped out. You can do that as well. Don't say you're going to like it. I don't say that it's going to be fun, but it's not about fun. It's about being responsible for your actions and knowing that you've done the right thing. You've exited a trade for a controllable loss, and that's good. That's a positive, and that's the only way I could put any kind of positive spin on a negative event. Okay, that all brings us to risk reward and what it is. Okay, just got some more questions. Okay, so you're just saying you always get in the market right before it reverses. What do you think the issues? Well, again, if you're getting, do you mean you get the market right before it reverses, or I'm not quite sure about that, GY. I want to just expand upon that a little bit. I'll come back to that. All right, risk reward. There's a question throughout a lot of my seminars, a lot of my personal, kind of coaching sessions. What's the correct risk reward? Now, knowing your trading strategy, what product you trade, the size you trade, how aggressive you are, etc., etc., I cannot tell you the exact risk reward. However, the staple is it's got to be a minimum of 1 to 2. If you're risking £1,000, so that means your stop or what you're going to go negative in that trade is £1,000 down. You have to be looking to make 2,000. Okay, so you don't always have to look at it in monetary terms. A lot of people prefer to look at it in percentage terms or tick values. So if you're going to translate that into ticks or increments, pips, whatever you want to call them, movements, if you want to make 60 ticks out of a market, then your stop loss needs to be between 20 and 30 pips from your entry price. Simple as that. Okay, so when the market comes against you 20 ticks, that's you out the trade. You were looking to make 60, you've lost 20. It's manageable. That's it. All you have to do is reevaluate, do a new trade. Yeah, I mean, again, you could reverse the trade, but again, is the market just going further against you before the actual right move happens? If you're looking to buy the market and it moves down 20, 30 ticks, remember, you have things like stop grabbers, you have people that can, short and short terms manipulate the markets, and, when you hear about the markets getting squeezed, everyone might know that the market's going to eventually end up, but in the meantime, the market will get pushed down to get all the longs out. Then when everybody's out and they're just about to reverse and go short because it can't possibly go up again, the market does exactly what you think and goes up, and everyone gets caught on the wrong side. That happens every day in the markets. So again, it's all about knowing the entry point. Is the market being moved around before it goes in the eventual direction that everyone thinks? So how can you protect your capital in volatile markets? Okay, and again, it's a big issue at the minute. A lot of professional traders, a lot of guys I work with in the city have just generally stopped trading. Okay, because the markets, we can't find tops anymore. We can't find bottoms. The market gets pushed, it gets winged around, and it just generally is volatile and difficult to keep any kind of structured risk. So some basic rules here you need to adhere to when the markets are heavily trending in one direction or overextending. So, number one, as I said, use stops. Doesn't matter if they're a fixed stop, as we talked about, or trailing, whereas a trailing stop will move, again, maybe 10, 15 ticks behind whatever your trade is moving up or down. So it's not a fixed price, it's just a fixed number of movements behind your entry point. Okay, so it doesn't matter. But if you don't have the protection in place, then, where's your out? Are you just going to press the button when, it's too late? Or is the market just going to stop you out because you're out of capital? Yeah? If we don't have an out, then really, we shouldn't really be trading, no fairness. So check the news. So fundamentals are driving the market in one particular direction. Are you still correct in your analysis? Is there something you haven't heard about? Again, there's a lot of Squawk services available, which will tell you about market rumours, give you market information. It's always handy to have something like that in the background because other people are listening to it. There's a rumour, as there was, a few weeks back about Moody's downgrading the banks. So the market sold off because of that. Even when the market came out, the market continued to sell off, but it already moved significantly enough, for it not really to be that worthwhile getting short when the actual rumour was confirmed. So again, you can trade off rumours as long as you have a risk reward in place. It doesn't matter the rumours, they're still going to move the market. Again, that's the joys of trading. There can be rumours that are untrue, you can still make money. There can be rumours that turn out to be true, you can still make money. It doesn't really matter, does it? If you're on the right side of it and haven't taken on too much risk, that's money in your pocket. And that's the freedom we have in the markets. So again, if you're trading badly, cut your size. Yeah? Or if the markets are really, really volatile, trade smaller size. Smaller size, less risk. But, if the market's moving 2 or 3 times more than they were in the previous sessions, days or weeks, then you can make more money. If you're just looking to make 20 ticks out of a move, but then you can make 60 ticks out of a move, you can still make more money or the same money on less size. The less size, less risk. Simple. Very, very easy. Okay, trade less. Another observation through years and years of watching people trade, over trading. Okay, it's your worst enemy. Boredom trades, the markets are moving, quickly up and down. But again, you're trying to get involved in each little bit of movement. So you're over trading. Again, the more you trade, the more likelihood is you're going to get caught up in noise and you're going to, lose in trades. But the market's going to go from point A to eventually point B. So that's what you need to do. Trade once and hold on to it and try and fade out the noise rather than trying to trade every opportunity. Yeah? The less you trade, the less chance you have of losing. So again, it's all down to your risk profile, your risk strategy, who you are. Some people like to be in and out of the markets constantly. But remember, if you're spread betting, you're always paying the spread. So the more you trade, the more you pay. So you want to keep your costs down and you want to keep your risk down, trade less. Okay, you're usually told volatility is needed to trade. Well, yeah, but you can trade sideways markets. You can trade any market. As long as you understand what the market is, it doesn't make any difference. It could be a trending, a ranging, a volatile market. It doesn't matter. If you understand how the market's trading, you can understand how you want to get involved and control your risk accordingly. So it's no more difficult than that. And again, I try not to tell you how to trade. The trading's down to you, I'm afraid. I just tell you the different techniques, the different things I've learnt, and the different things that, have worked for me and haven't worked for me. And that's not just me. That's from managing hundreds and hundreds and teaching hundreds of people to trade. Okay, it's just seeing the same things over and over again that people do wrong and letting them cut that out and then finding their own way. I can't tell you how to trade and consistently make money. Nobody can. Yeah, that's why there's no one book, there's no one strategy, there's no one expert that can tell you how to consistently make money. Because guarantee, if they could, they'd be doing it themselves. Now again, I've been lucky enough to be trading for 10 years. I don't have to work anymore. I do these things because I enjoy it. And I get paid a lot of money to do it. So if I wanted to take all these things and go and trade in the markets, I could. But I've done that. I've earned my stripes. I've had my decade in the markets. I don't want to do it anymore. I've got things I want to do. I want to spend time. I don't want to think about the markets. Doesn't mean I'm not passionate about them. It doesn't mean that I don't want to pass on that information, that enthusiasm and that drive to other people. I certainly do. Okay? But again, it's all got to have to make trading personal. It's all what is personal and works for you. What works for me might not work for you. That's why I write all these presentations and I write my courses and all the things that I publish. Again, are just for you to build your own opinions off and trade off the back of. I'm not telling you how to trade. Okay, some more questions. How many instruments should one trade at the same time? Does trading more instruments at the same time cause problems? Yeah, again, the more things you trade, the more money you have to have in your account, the more things you have to look at. So I would say try and be an expert in one or two markets. Again, I trade generally the S&P because I understand how it moves. I've traded it for a long time and I'm comfortable with it. You don't have to be trading, in loads of different markets to make money. You can make just as much money in one market by trading the correct size and risk strategy as you can by trading every market. So again, whatever works for you. If you want to be like I was in the city and have 10 screens, load of charts and trade every market, that's fine. But again, what you have to do is do what works for you. It's different for every person. Okay, do you have any experience with FXCM, spread betting, MetaTrader platform? Yes, I do. I'm good friends with the owners of FXCM. So, yeah, I know plenty about them. JD, can we get a copy of this deck? I'm not quite sure what you mean by deck, though, JD. Do you want to just expand upon that? Okay, so we're just talking about stops. Again, keep typing the questions, guys. I'll always come back to them. Again, sometimes you can lose your capital as the market moves against you. And then, again, the market will reverse and go in exactly the way you believe. Again, this is just something that happens in trading. It happens all the time. Don't take it personally. And again, if you've got your stop in place, you shouldn't have lost too much for it to be a real issue anyway. And remember, stops allow you to take a step back take a breather and reevaluate the market. So yes, okay, this is recorded, JD, as always. I guess Maud will be able to let us know, but you can go over this presentation again. Do I recommend FXCM? Sure, yeah, I don't disrecommend them. Again, if you're going to go for the recommended sites and all the things that I use, just Google Trader Maker. That'll tell you all my opinions, who I am and what I do. That's me. I don't need to talk about it in these presentations. I'm just trying to give you the material of what we've agreed to talk about. So if you want to just Google Trader Maker, that's me. You can find everything that I stand for. So remember, as I said earlier on, guys, you have to think about these excuses. Because again, who's going to listen apart from yourself? Nobody. Nobody likes people that have excuses and whine. So if you've ever said this, I got stopped out and then the market went exactly where I thought it was going. I translate this. This is what I tell other people that I mentor and that I've risked before. That just means the entry level was wrong and you misjudge where the market might go before it goes on side. Or I put a position on that was too big for me. I couldn't handle that risk, so I got out because I didn't want to lose the money. Yeah? That's what getting stopped out really translates to. So the more you control that, and the more that, you get into this art, which trading is an art, of judging where the market can go before it hits your target, then adjusting your entry and your size accordingly. This is what's going to make you a successful, consistent trader. These things put together. And again, when you do it, it's a very, very powerful thing. And again, the excuses, we have to keep them to a minimum. We're allowed to get angry, but it has to be controlled. We're allowed to be disappointed, but it shouldn't dent our confidence. And that's the whole point of risk and risk management and trading in volatile markets, is everything put together. It's your psychology, your planning, your mental state, all these things, okay, why and how you get involved in the markets. They're all just as important as each other. So again, how you conserve your money in these volatile markets, okay, keep to your rules, as we've talked about. Pick the time of day to trade. You might be a morning trader, or you might be an afternoon trader. The markets trade differently in the we'll be trading things like the FTSE, etc. when the S&P opens in the US. Number 3, use your stops. Okay, negative and positively average. Okay, so if you trade smaller size, you can add to your positions if they go against you, or add to your positions as they go on side. It's a very powerful thing to do. And again, it's a controlled and responsible way of trading. Okay, then manage your size. Make sure you're trading the right size for the right market conditions. Yeah, just because you can make money on the upside doesn't mean, well, it does mean actually that you can lose just as much on the downside if you're trading big size. So if you're trading a good percentage of your account, it's great when you get it right, you're going to make some good money. But when you're wrong, you're going to lose more money than you normally would, because the market will move quicker, faster against you than it would in normal trading terms. And if you don't have your stops in place, where's your out? These are where, we can get really caught in the market and lose big time. So again, have your trading rules in front of you, make them physical. Write down your levels in big writing, write down your rules in big writing. Have it by the side of your PC. Look at it all the time. If you're looking at your trade and you're 20 ticks offside, and your risk says you have to get out of your 20 ticks offside, look at it. Yeah, it's your rule. Only you write it, and only you can see it. So get out of that trade. So stick to the rules. Don't write the rules down if you're not going to stick to them. They're absolutely meaningless. They're pointless. Yep, so make sure your rules take into account your capital, how much you've actually physically got, to make it realistic. You've got £10 million in the account, don't get stopped out for 50 quid. Simple, a crazy example, but, it's all relevant. Yeah, and then, again, the trade frequency and the size should all be calculated from how much money you have in the pot. Make it realistic. You've got £1,000, don't trade pounds. If you've got £10,000, trade accordingly, trade £10 a tick. Whatever you're looking to make out of trading physically and, monetary-wise has to be calculated from what you've got in the pot that allows you to trade. So again, knowing the market conditions and volatility can change these rules accordingly, but you have to be aware. They have to be, addressed. So remember, again, the time of the day. If you're trading UK markets, you may get initial moves in the market in the morning, then we'll slow down, and in the afternoon we'll form a new or a continuation of the trend when the US opens. So again, are you a morning person or an afternoon person? Some people don't like getting up, feel a bit groggy, might trade badly. Again, if you don't record your trades, how are you going to know how the time of day affects your profitability? So again, what time periods you trade in, build that into your risk reward. The use of stops, as I keep saying, in volatile markets, you have to use stops. Yeah? So, again, and adapt it to your trading style. If you're looking to make 15 ticks, then again, it's a fairly short-term trade, so only risk 5. But if you're looking to make 100, risk between 30 and 40. Again, have the right risk reward for the market conditions. So again, there's a common term used, always get stops out of trades. That's all down to your entry point. So into nothing else but the size and the entry point you get into that trade. As I said, you can negative or positively average. Now negative, that's when the trade is against you, it's going against your view, and it goes offside. Okay, so offside is when the trade is going into negative territory and going away from your entry point. But what you can do is you can negatively average, and you can buy or sell more at a better price in order to even out that pain. When you positively average, that's when you're onside and you're going with the momentum and you put more into the trade because you want to have more size going with the momentum. Yeah, so that's another technique. And if you trade smaller size, the more you can negative or positively average, because again, the more capital you'll have to play with, and again, you won't be scared or frightened out of positions because again, you're not trading your full size or your full account. And again, very important to manage your size. That when you have volatile markets, you might want to trade less size or run smaller positions because you don't want, to experience the pain. So again, if market moves 3 or 4% in a day, you can still make the same amount of money with the original size because markets move further. Simple. Okay, and smaller positions allow you to build bigger positions. Bigger positions don't. Yeah? If you've got all your account on one size, you either kind of get out of it or you don't. If you've got smaller positions, you can build them up. Yeah? And start to build a stronger, better position. And again, you go in with your own momentum when you're positively average. And if other people are doing this, it will make the markets move even quicker and even further. So in conclusion, the risk management is the art of balancing profit expectations versus the manageable losses. Okay? Don't expect to get the markets correct all the time. It isn't going to happen. And build it into your trading plan. Build a set % of losses you're going to experience every month. And make sure you break that into your daily, weekly targets to know how much you're probably going to lose. If you don't lose it, happy days. If you do, stick to your risk reward. It should all tie in. So again, when you do lose, try to keep it small compared to your profits. Simple. Yeah? Keep your losses small, run your profits. Sounds crazy, but it's not. That's how you make money in trading. And again, if you achieve 7 out of 10 winning trades, then you can't let them 3 losing trades be whoppers. Okay? Yeah, they've got to be controllable. So 7 winning trades have to outbalance the 3 losing ones, or you're not going to survive in trading. Alright guys, well that's pretty much all about volatile markets, money management, cash management, the attitude we need to have. Any questions, any thoughts we have on that, guys? We've got roughly, I guess, about another 7 or 8 minutes before we get the call to wrap it up. Okay, Yusuf is asking, what's my percentage, winning percentage per month? Well, mine's about 90%. I generally have a big enough account that I generally don't lose. But, again, as everyone does, I will take the odd wrong trade, the wrong opinion, or just get out of a trade because I'm not willing to manage it or stay with it. Yeah, well, I don't trade very often. Again, I mean, there's no surprise that I'm holding these seminars and teaching this stuff because that's, I'm the real deal. I don't trade that much these days because I don't have to. I find this interaction with the courses, the material I write, a lot more fulfilling than I do spending 16 hours a day trading the markets. Risk reward, it depends, Yusuf. Again, risk reward's a very personal thing. My risk reward won't be the same as yours. It'll be very different. I hold positions for days, weeks. So I couldn't really tell you, as I said to you in the presentation, I can't tell you the correct risk reward is different for different people. What do I think for the Forex markets now, Buki? Again, I try not to give too much of my personal opinions away because I don't want to skew what you think. But the euro, in my opinion, is doomed. I can't see any good news, and for Germany, etc., to keep printing money and bailing people out, it's not going to change Greece, is it? It's not going to make Greece more industrious or more profitable. It's not going to make the Italians more honest and pay their taxes. It's not going to make the Spanish any less lazy. I don't know. But, You just got to listen to the fundamentals, build up your own view, and see what happens. Again, who knows? Interesting times. Interesting times. A lot of opportunities to make money, but again, a lot of opportunities to lose money. So that's where the risk management and the control comes into it. Okay, do I exit before my stop is hit? Well, it depends. I very rarely trade with stops these days, but again, that's because I have a big account and I like to negative and positive average. But if I've got a stop in place where I know the market's going to break below and then my opinion is wrong, then yeah, of course I will. I have no problem getting stopped out for losing trades. Absolutely no problem at all. It takes years to learn, and nobody likes it, but it's just a fact of trading. If you're wrong, get out. I'd rather know that I've lost a fixed amount of money than wake up in the morning and having perhaps not slept or anything because there's some new fundamental or something I couldn't control and you've lost even more. All right, I'm being told to wrap this up, guys. So again, thanks for joining. I'm going to feature again probably an FXG at some point. I'll just check my page whenever you can. If you want to find out my views on what I do, just Google Trader Maker. I'm number 1. You'll be able to find me. It's been an absolute pleasure, guys. I'd like to thank Maud and the other guys at FX Street.